Stop for a moment and think about what this really means. Silver is trading at $125 per ounce on the Shanghai Futures Exchange, while COMEX sits near $110. That is a $15 to $7 premium in a globally traded strategic metal. In efficient markets, gaps like this do not last. They close quickly through arbitrage. When they do not, it signals stress beneath the surface. This is not just a rally, this is not routine volatility. This is a divergence between physical demand in the world's largest manufacturing economy and paper pricing in Western futures markets. When physical markets begin to separate from paper benchmarks, professionals pay attention. We are potentially witnessing a structural shift in how silver is valued globally. Declining inventories, tightening supply chains, rising industrial demand, and geopolitical fragmentation are converging at the same time. The real question is no longer whether silver is moving higher. The real question is whether the global pricing mechanism itself is being tested. A $15 to $17 premium between Shanghai and COMEX is not a routine market fluctuation. It is a pricing distortion that demands serious attention. In globally traded commodities like silver, regional premiums typically remain narrow because arbitrage mechanisms keep markets aligned. When that spread widens dramatically and persists, it signals stress inside the physical supply chain. This is not about excitement over a rising price. It is about what the divergence is revealing beneath the surface. Ask yourself a simple question. If silver is freely available at $110 in New York, why is it commanding $125 in Shanghai? In an efficient market, traders would immediately buy in the lower-priced market, transport the metal, and sell into the higher-priced one, quickly compressing the spread. When that does not happen fast enough, the logical conclusion is that access to deliverable metal is constrained. Either the metal is not readily available in the quantities required, logistical channels are tight, regulatory barriers exist, or strategic buyers are absorbing supply before it can move. Shanghai is not a peripheral marketplace. China is the largest industrial consumer of silver globally, driven by solar manufacturing, electronics production, and advanced infrastructure development. When that market is willing to pay a double-digit premium over Western futures pricing, it suggests urgency. Industrial buyers do not typically overpay without reason. A sustained premium implies that immediate access to physical metal has become more important than price efficiency. This kind of divergence also challenges the assumption that paper markets always reflect real-world supply and demand conditions. Futures exchanges rely on confidence that contracts can be settled with deliverable inventory if required. When a major consuming region prices physical metal significantly above futures benchmarks, it raises questions about whether paper pricing fully reflects physical tightness. Professionals monitor these signals closely because they often come before broader repricing events. A regional premium of this size is not noise. It is the market communicating imbalance. The longer it persists, the more it suggests structural rather than temporary stress. In commodities, structural stress rarely resolves quietly. A breakdown in arbitrage is one of the clearest warning signals in commodity markets. Under normal conditions, price differences between two major exchanges do not last. If silver trades meaningfully higher in Shanghai than on COMEX, traders should immediately step in to exploit that spread. They would buy futures or physical metal in the lower-priced market, arrange shipment, hedge currency exposure if necessary, and deliver into the higher-priced market. That flow of capital and metal typically compresses the gap quickly. When the spread remains wide, the market is telling you something important. The question is not whether arbitrage exists in theory. The question is why it is not functioning in practice. A persistent $15 to $7 gap suggests friction somewhere in the system. It may be limited availability of registered, deliverable silver in Western vaults. It may be transportation bottlenecks, insurance constraints, regulatory restrictions, or capital controls that slow cross-border metal movement. It may also reflect strategic buying that absorbs supply before it can leave the domestic market. None of these factors are trivial. Physical silver is not a digital asset that can be transferred instantly across continents. It must be allocated, transported, insured, and cleared. If inventories are already tight, large volumes cannot be mobilized quickly without disrupting existing contracts. In that environment, theoretical arbitrage profits do not automatically translate into executable trades. The spread persists because the metal cannot move efficiently enough to close it. There is also a deeper financial implication. Futures markets depend on confidence in delivery mechanisms. If market participants begin to suspect that obtaining physical metal is more difficult than contract pricing suggests, the credibility of paper benchmarks weakens. A widening and persistent arbitrage gap raises concerns about the true state of supply versus what open interest implies. Professional investors watch these situations closely because they reveal structural constraints before headlines catch up. When arbitrage slows or stalls in a globally traded metal, it signals that liquidity in the physical market may be thinner than assumed. In commodities, impaired arbitrage is rarely random. It is often the first visible crack in a system under pressure. Declining registered inventories on COMEX should never be dismissed as a minor technical detail. Registered silver represents the metal that is actually available for delivery against futures contracts. It is not theoretical supply. It is not total warehouse stock. It is the portion specifically designated and ready to meet delivery obligations. When that pool trends downward while open interest remains elevated, the structure of the market becomes increasingly sensitive to stress. Consider the mechanics for a moment. Futures markets function smoothly because most contracts are rolled or settled financially before delivery. Only a small percentage typically demands physical settlement. That system works efficiently as long as participants believe delivery is available if requested. Confidence, not constant delivery, sustains the structure. But when registered inventories decline steadily, that cushion shrinks. The ratio between paper claims and deliverable ounces becomes more strained. If open interest represents multiples of the registered inventory, even a modest increase in delivery demand can create tension. It does not require every contract holder to stand for delivery. It only requires a shift in behavior. If a larger share of market participants decide they want metal rather than cash settlement, the exchange must rely on reclassification of eligible inventory, rapid inflows, or alternative settlement mechanisms to maintain order. We have already seen periods where millions of ounces are reclassified between eligible and registered categories. That flexibility is part of the system, but it also signals that inventories are being actively managed under pressure. The more frequently that reclassification occurs, the more closely professionals examine whether the supply pipeline is tightening. At the same time, industrial demand for silver continues to expand. When physical demand rises while deliverable exchange inventories trend lower, the margin for error narrows. Futures markets are highly efficient under normal conditions, but they are also leveraged systems. A relatively small imbalance between physical availability and contract exposure can amplify volatility. This is why inventory data matters. It is not about daily price movement. It is about underlying resilience. When registered stocks decline during a period of rising global demand and regional premiums, the message is clear. The physical foundation supporting the paper market becomes thinner, and thinner foundations tend to magnify stress when pressure builds. Industrial demand for silver is not cyclical speculation. It is structural necessity. That distinction matters. When investors evaluate a commodity rally, the first question is whether demand is discretionary or non-discretionary. In silver's case, a significant and growing portion of global consumption is embedded in technologies that modern economies cannot easily pause or replace. Consider the scale of solar expansion alone. Photovoltaic cells rely on silver for conductivity and efficiency. As nations accelerate renewable energy targets, gigawatts of solar capacity are being added every year. Each panel requires a measurable amount of silver. Multiply that across national infrastructure plans, and the volume becomes substantial. This is not a luxury trend that fades with consumer sentiment. It is policy-driven industrial deployment backed by government mandates and capital budgets. Electric vehicles add another layer of demand. High-efficiency electrical systems, battery management components, and onboard electronics all rely on silver for its conductivity and durability. The broader electrification of transportation increases silver consumption per vehicle compared to traditional combustion models. When policymakers commit to electrification timelines, they indirectly commit to sustained silver demand. Advanced electronics, 5G infrastructure, artificial intelligence data centers, and defense systems further reinforce this structural pull. Silver's conductivity properties are difficult to replicate economically at scale. Substitution is technically possible in limited applications, but often at higher cost or reduced performance. When performance standards are non-negotiable, particularly in defense or high-performance computing, silver becomes essential rather than optional. Now consider the supply side. Global mine output does not adjust quickly to price spikes. A large share of silver production is a byproduct of mining for other metals such as copper, lead, and zinc. That means silver supply is partially dependent on the economics of entirely different markets. Even if silver prices surge, producers cannot instantly increase output without corresponding shifts in base metal production. When a commodity faces rising, policy-driven industrial demand, and constrained supply flexibility, price sensitivity increases. Small imbalances can produce outsized reactions. This is why industrial silver demand deserves careful attention. It is embedded in long-term infrastructure, technology, and energy strategies that do not reverse easily when prices rise. Geopolitical fragmentation is no longer a theoretical risk discussed in policy circles. It is actively reshaping commodity flows in real time. For decades, global trade operated on the assumption that materials would move efficiently across borders with minimal political interference. That assumption is weakening. Export controls, tariffs, sanctions, and reshoring initiatives are introducing friction into supply chains that were once optimized purely for cost and efficiency. When a major economy imposes export controls on critical metals or strategic materials, it changes the calculation for global buyers. Access becomes uncertain. Timing becomes unpredictable. In that environment, price is no longer the only variable. Security of supply becomes equally important. A regional premium for silver can reflect this shift from price optimization to supply assurance. Buyers may be willing to pay more today to eliminate the risk of not having material tomorrow. Reshoring and onshoring policies further complicate the picture. Governments seeking domestic manufacturing resilience are encouraging local production of electronics, renewable energy components, and defense systems. These industries require stable access to inputs like silver. If global trade flows are viewed as politically vulnerable, strategic stockpiling becomes rational rather than speculative. That behavior tightens spot markets even if headline supply appears adequate. Tariffs and trade disputes also distort price signals. When trade barriers increase transaction costs or restrict certain flows, regional pricing can separate from global benchmarks. In a fragmented system, the idea of a single global price becomes less reliable. Localized supply and demand dynamics begin to exert stronger influence. A sustained premium in one region may reflect structural isolation rather than a temporary imbalance. Financial markets often lag behind geopolitical reality. Paper pricing mechanisms assume frictionless movement of goods. But when political decisions restrict or delay physical transfer, arbitrage slows and spreads widen. Investors who ignore geopolitical drivers risk misreading price action as purely speculative. This is why silver's regional premium must be viewed through a strategic lens. In a world where economic blocks are consolidating and supply chains are being rebuilt for resilience rather than efficiency, commodity pricing becomes more sensitive to political risk. Fragmentation does not eliminate global trade, but it reduces its predictability. Reduced predictability increases the value of immediate local access to critical materials, and that dynamic can reshape pricing structures faster than traditional models expect. One of the most underestimated dynamics in the silver market is the persistent underallocation by Western institutional capital. For years, large pension funds, hedge funds, and sovereign wealth funds outside of Asia have maintained relatively small exposure to precious metals, particularly silver. Portfolio models have favored equities, private equity, technology, and fixed income, while commodities have often been treated as tactical rather than strategic allocations. That positioning creates a hidden variable in the current environment. Ask a critical question. What happens if price leadership shifts decisively to Asia and forces a reassessment in the West? Institutional capital does not move emotionally, but it does respond to structural signals. A sustained regional premium, tightening inventories, and industrial demand growth can trigger internal reviews. Once allocation frameworks begin to adjust, the scale of potential inflows changes dramatically. Silver's market size is relatively small compared to global equity and bond markets. It does not require massive capital reallocation to move prices significantly. Even a modest shift in portfolio weighting from near zero exposure to a low single-digit percentage can represent billions of dollars in incremental demand. In a market already experiencing physical tightness, that incremental demand can amplify volatility considerably. There is also a performance component. Institutional investors monitor momentum and relative strength. If silver begins outperforming traditional asset classes while macro uncertainty increases, pressure builds internally to justify underexposure. No fund manager wants to explain persistent underperformance due to ignoring a structural commodity rally. This is how capital rotation begins, not with panic, but with measured adjustments that accumulate over time. Institutional participation can also alter market structure. Increased futures activity, options hedging, and ETF inflows expand liquidity, but can also intensify short-term swings. If Western funds attempt to capture arbitrage opportunities between exchanges or hedge supply risk for industrial holdings, the interaction between paper and physical markets becomes more complex. The key point is that current positioning matters as much as fundamentals. A market that is already heavily owned has limited room for new buyers. A market that is underowned, however, carries significant potential if sentiment shifts. In silver's case, the combination of structural demand signals and low institutional exposure creates a situation where even disciplined, incremental allocation changes could have an outsized price impact. No serious financial discussion is complete without confronting risk with equal honesty. Silver is historically one of the most volatile major commodities. Rapid upward moves often invite equally aggressive corrections. A $15 to $20 swing within days is not unusual in this market. Participants who enter without understanding that volatility profile expose themselves to forced liquidations rather than calculated investment decisions. Margin policy is a primary risk factor. Futures exchanges retain the authority to raise margin requirements during periods of heightened volatility. When margins rise, leveraged participants must either post additional capital or reduce positions. That forced adjustment can accelerate downward price movement even if underlying fundamentals remain unchanged. Markets do not decline only because fundamentals deteriorate. They often decline because leverage must unwind. Cash settlement mechanisms represent another structural variable. Futures markets are designed to maintain orderly function. In extreme stress scenarios, exchanges can implement measures that reduce delivery pressure, including encouraging financial settlement rather than physical transfer. While such tools are part of the system's design, their use can temporarily relieve physical stress while creating uncertainty about true supply conditions. Profit-taking is a more immediate risk. Traders who accumulated positions at significantly lower price levels may view sharp rallies as opportunities to lock in gains. Institutional desks, proprietary traders, and commodity funds often operate with disciplined profit targets. When multiple participants move to secure returns at the same time, short-term supply increases regardless of longer-term scarcity narratives. Macro conditions also carry weight. A sudden strengthening of the US dollar, unexpected monetary tightening, or a liquidity shock across global markets can pressure commodities broadly. In risk-off environments, even assets with strong structural demand can experience liquidation as investors raise cash. Silver does not trade in isolation. It reacts to currency movements, interest rate expectations, and broader financial stress. Over-leverage remains the most personal risk factor. Participants trading on margin or allocating capital they cannot afford to hold through volatility are particularly vulnerable. Markets reward discipline and punish emotional reactions. Entering during sharp upward moves without predefined risk parameters increases exposure to sudden reversals. Recognizing these risks does not invalidate the case for silver. It strengthens the quality of the analysis. Sustainable participation in volatile markets requires the awareness that structural demand and short-term price behavior do not always move in a straight line. Silver at 125 in Shanghai and 110 in the United States is more than a headline. It reflects tension between physical supply and paper valuation. It reflects industrial urgency, geopolitical strategy, and shifting capital flows. Whether this divergence resolves quietly or evolves into a broader repricing will depend on inventories, institutional positioning, and macro conditions. Watch the data, watch the premiums, watch the inventories. Markets reveal structural change before policymakers acknowledge it. Stay disciplined, stay analytical. In times of volatility, make decisions based on structure, not emotion. World History Finance.